Happy Thursday, everyone. Giving folks a few minutes to join us, and we'll get started. Okay, happy Thursday again, or happy Friday Eve, as I like to say. Today's webinar, Financial Planning Fundamentals for Engineering Professionals, brought to you by the ASABE Foundation. My name is Liz Metz. I'm Development Director for both the Society and the Foundation of ASABE. On behalf of the ASABE Foundation, thank you for joining us today for this important discussion on financial planning strategies tailored specifically for engineering professionals like you. We are honored today to have with us Tom Hodgson, a seasoned investment advisor with Lutz, who brings extensive experience in financial planning and wealth management. Tom specializes in helping professionals like you navigate the complexities of retirement planning, insurance, investments, and estate planning. During today's session, Tom will cover tax-advantaged retirement options, essential insurance and benefits planning, investment strategies for long-term success, and estate and legacy planning fundamentals. Before he gets started, just a few quick housekeeping tips. The session is slated for approximately 1 hour. We'll have time for question and answers at the end. Feel free to submit your questions in the chat box throughout the presentation. We are recording today's webinar, and a replay will be available to registered attendees. If you experience any technical difficulties, please reach out via chat, and we will be happy to assist you. With that, let's get started. Please join me in welcoming Tom Hodgson.
Thank you, Liz. We appreciate the introduction. Thank you for getting us set up. Again, I'm going to go through a lot of topics that Liz just mentioned. Feel free to ask questions throughout. If it's kind of pertinent to the slide that we're going through, I'll try to answer those in that section. Obviously, if it's something towards the end, happy to circle back on any of those topics. And again, I know Liz just ran through this. I'll leave it up here briefly so you all can see this as well to kind of get a prep of what we're going through. So the first one that I wanted to start with is understanding the tax advantage retirement options. And I think, again, I've worked with a lot of engineers, and I think one of the takeaways that I've always noticed with engineers is that they tend to be technical and analytical, and they also try to solve problems. And I think that is kind of at the root of understanding the big picture. The more that you understand and know something, the more it's going to resonate, the more it's going to stick. So I want to start off by just understanding taxes on two different levels: ordinary income, which is how wages are taxed, how a lot of income is taxed. So when we start, you're going to see that taxes kind of fill in from the bottom up. So the first dollar that you earn is taxed at the very bottom. And then as you go up that scale, you're going to see that dollars are taxed at the higher income brackets. The second part of this is, what is the impact of tax deductions? So you're going to see that those come from the top down. So if based off of your income tax bracket, you're in the 35% bracket on each incremental dollar that you earn, any tax deductions are going to come off of that 35% bracket. So I think that's a big piece of understanding, how you should be saving for retirement, what buckets you should be using, because there's going to be kind of ebbs and flows throughout your career where you might be, earlier in your career and be in a younger or kind of a lower income bracket. That might be a time that you want to pay the taxes now, get growth tax free. There's going to be times where you're in your peak earning years and you really want to defer and avoid paying taxes, knowing or thinking that you're going to be in a lower tax bracket later on when you get into retirement. The second part of understanding taxes is capital gains and how those are taxed. Capital gains are generally taxed when you sell an asset that's been held for over a year. That would be a long-term capital gain. So that could be a stock, that could be a business, that could be a property, a home, second home, farm. So any of those are going to be taxed as capital gains. But one important distinction is that capital gains are always added on top of your other ordinary income. So when you think of like an investment portfolio, if you own stocks and you've held it for over a year and you sell that, that is going to be taxed anywhere from 0, 15, or 20%, depending on where you fall in that range. But that is going to be on top of where your ordinary income is taxed first. So I think that's an important distinction because, again, understanding how that works will help lead to understanding, the best tax strategies from a retirement perspective. So I think that's really where this all starts, is take a step back and look at what your current marginal tax rate is. And when I say marginal tax rate, that's the tax impact of your next dollar earned. So again, for an easy example, if you are currently making $100,000 and you got a bonus of $5,000, what is that next $5,000 going to be taxed at? So that would be your incremental tax dollars. And then what's your expected retirement tax rate? So again, this is important because if you're deferring right now and you're in a low tax bracket, you're saying, I don't want to pay taxes at this rate. But if you're in a higher bracket later, you're actually pulling dollars out at a higher tax rate. But there's other kind of key considerations that we want to think through when we're talking about kind of these two stages. So again, what are going to be your income sources in retirement? Will they be taxable or not? So Social Security is obviously one that majority of people here in the U.S. are going to receive. There is some offset. If you have a pension, you may not receive Social Security depending on how the pension is structured. But that would be another source of income. Business income, if you're a business owner, maybe you still retain that business in retirement and you collect income off of that. Real estate is another one that we see a lot of clients have. Maybe it's something that again, you own the building of the practice that you have. So all of those sources of retirement income kind of matter when we're thinking of where you're at today and where you're going to be in retirement. A few variables that we don't know be legislation. Again, we know what the tax rates are right now. I know under the current tax laws, they're scheduled to sunset at the end of this year. Obviously, with the election outcome, there's now a belief out there that there's going to be some tax changes going into next year. I would tell you that we don't try to forecast what those would be, but we always want to take a look at that and see big picture, how that's going to impact it. And then I would also say, charitable intentions can be a big piece of this as well. If you're deferring, and we'll talk more about charity kind of later on in some of the estate planning, advanced planning stuff. But if you're planning to give to an organization, what's the best way to maximize that component? So really, there's going to be 3 retirement buckets when we think about kind of the main investment buckets. So you've got Roth assets. These are assets that you pay the taxes on right now. The portfolio grows tax-free and all distributions are tax-free. And as you can see on the screen, who should be doing Roth? I would say specifically anyone that believes they're going to be in a higher tax bracket in retirement. This is a great bucket to use at any given point. And really, I would say this is a year-by-year basis because your income situation is going to evolve, tax legislation is going to evolve, but knowing where you're positioned right now allows you to take advantage of that. So unfortunately, there's generally not a one-size-fits-all answer for which bucket to use, but it's going to be specific on each person or each couple's tax situation. Pre-tax, this is probably the most common method of saving for retirement. Think of a 401k, a traditional IRA. Here you get that tax deduction in the year you make a contribution. Any growth is tax deferred, which means that dividends and interest kind of get accumulated inside of that bucket, but you don't pay taxes until you pull dollars out. Any distribution you take is going to be taxable to you at retirement. One caveat with that pre-tax bucket, this is the bucket that can be used for charitable gifts at some point. Again, the rule is age 70 and a half, but you can give directly from an IRA to charity, and then those dollars were never taxed. So that can be a powerful gift as well. The last bucket is a taxable account. So think of this as like an individual account, a joint, a trust, any bucket that you're using dollars that more or less are inside of your checking account or savings account. You invest them inside of a brokerage account. And then obviously the goal is for that to grow over time. There you're going to have dividends and interest. Those are taxable on an annual basis, but those do also help increase your cost basis over time. That's really a great bucket where, maybe you've already maxed out your 401k or your employer plan, whatever that may be. You've got some excess cash that you don't need to use on the short term, but you want that to invest and grow for you over the long term. That's really a great bucket that can kind of fill up that last one. And then I think, again, this is just an important slide to see because this is going back, again, about 70 years and looking at historical tax rates. You can see that this has fluctuated over time. Obviously, early in the 1950s, we were coming off wartime. Not everyone was in that top tax rate, but you can kind of see that this does change periodically. So we always want to know where we're at and what could potentially change, just to know if we are in a historically high or low tax environment. And I would say that we're kind of at a long-term equilibrium right now. We're a little bit lower than we were back in 2017, but again, it's kind of right in that same area. Any questions so far? Okay. All right, so we're going to switch gears here, and we're going to look at the insurance side of it and benefits planning. So I think there's really going to be multiple categories here. So, and again, with the attendees, I figured there's probably going to be some business owners, there's going to be some employees, there's going to be kind of a mix of demographic that's joining. So I want to start off by thinking about your employer benefits that are generally offered through who you work for. Health insurance is kind of the first one that we start with. I think the biggest, most important point here is to choose the right health insurance plan based off of your situation, your family situation, and looking at, again, the coverage that's available to you, what the deductibles might be, what your out-of-pocket costs are. But one important distinction here, if after evaluating that, you look at that and the high deductible health plan is the right choice for you and or your family, then contributing to an HSA, a health savings account, can be a big tax break for anyone in that bucket. The max amount that anyone can contribute for an individual is $4,300 for this year. For a family, it's $8,550 this year, $8,550, and there's an additional $1,000 allowable catch-up if you're over the age of 55. And how that works, you get a tax deduction on those dollars, and as long as those are used for medical expenses, qualified medical expenses, then those are not taxed at any point. So it's actually one of the most powerful tools that you can use, because you get the tax deduction, but and inside of there, you can pull it out without any taxes. Depending on which provider you have for a health savings account, you may have the ability to invest that as well. And the nice thing about the health savings account versus a flex spending account, the health savings account can roll from year to year. So you get to accumulate those dollars. You can eventually use those later on in life as well. If you're a very healthy individual and you never need those funds that are in a health savings account, at age 65, it will act like a traditional IRA where you can pull funds out. They don't have to be for medical, and then it's just taxed as ordinary income. So that can be a very powerful tool. Another insurance benefit that's generally offered through your employer, this can be done personally, but a lot of times your employer gets some discounts for doing it for a group of people. But there's disability insurance. So there's short-term disability and long-term disability. Short-term disability covers anything that's under about 90 days. Long-term disability is anything that's kind of that longer duration care. And I think this is an important distinction, because what I see on my side for clients that come in, disability tends to be probably one of the most underutilized insurance options, but there's statistically a higher chance of somebody going through a disability claim than a death claim. So think of life insurance versus disability insurance. So I do think it's an important thing to talk through. It may not be right for everyone, and the cost may be high. So that's something that you want to evaluate. But this is always where we want to look at that and say, how is this going to come to you? And again, when we think of disability coverage, I think the first thing that comes to mind is like an accident, whether it's at the job site or whether it's, driving a vehicle. If you're disabled for a period of time, you can't work, that would be a time that a claim can happen. But you also want to understand what your coverage is, because it can be illness related. Again, one thing that I've seen clients go through, and it's unfortunate, cancer is obviously a big thing that impacts a lot of people. If you can't work because you're receiving treatment or things like that, that could be a time that disability insurance also pays out to you and your family. And it can be a very important piece of the financial plan. Mental health conditions is another one that we've seen a lot more kind of getting publicized. And that's something too that, again, as long as the insurance covers that if you're getting treatment for some of those different disorders, can be something that you can receive disability insurance claims on. But I think the big thing is always knowing, again, what your options are, what amount of your income is replaced. Most disability insurance coverage has some amount of cap. It might be a dollar amount cap, where it might say, up to $10,000 a month of whatever your income was. It might be a percentage cap. It might say 2/3 of whatever your income was. And then the coverage type, the own occupation or any occupation, it's important to know because, again, working as engineers, if you were disabled and you couldn't go to the job site and do what you normally do, that would be your own occupation. You'd want to have coverage that protects that. You would not want them to say any occupation where, again, you could go and work at a retailer as a checkout cashier. That would be something that would be like any occupation. You can work in some capacity, but maybe not in your current capacity. Having the appropriate coverage can really protect you and your family. And then the last one that's generally offered through your employer is some sort of supplemental life insurance. A lot of employers might have some base amount. I would say that it's generally kind of tied to either a set amount, a smaller set amount, or some variable of your income. It might be like 1 times your salary, 5 times your salary, or it might be some limit on that. But that could be an option. And that is always priced off of just kind of industry standards. So it kind of looks at it and says, if you're, in this age range, this is your cost for insurance. Where obviously, if you go and apply for insurance on your personal side, it's going to be based off of your own health profile, statistics about people in that kind of demographic, and it may be more cost effective. And again, that's something that's worth evaluating on that side of it. So that's kind of where the personal insurance benefits jumps in. But now when you get to the personal insurance, there's going to be different components here too. So you can think of term life insurance, which is a temporary insurance policy. A lot of times you see a term of, let's say, 10 years, 20 years, or 30 years. You are the beneficiary or your family's beneficiary of this policy for that time period. Hopefully the point of that term insurance is to protect some sort of, catastrophic event where you pass away, but that would pay a benefit to your family. After that term has expired, then there's no more benefit. And then that ends up being the cheapest cost of insurance. There's also permanent insurance, which would be like a whole life, variable life, where there's some amount of payments that may go on forever. And maybe there's a larger payment up front to not have payments forever, but it stays in place for longer. That tends to be more expensive. I wouldn't say that that's necessarily a good or bad thing because the coverage covers a longer time period, but just something that's a key distinction there. I think one question that we get, and I've got a link on here so you'll have access to this, but how do you know what is the appropriate amount of coverage needed for any particular situation? So I've got some examples up here. This is definitely not a comprehensive list, but what's your current balance sheet? Somebody who's just out of college and is 22, let's say that they've got a young family, they've got a mortgage, they probably have a higher need for life insurance than somebody that's in their mid 60s that's getting close to retire. They've already accumulated their wealth. They've set that aside. Somebody in that situation may not need life insurance because they've already kind of planned for, what happens after they're gone. So this is kind of a good tool that you can plug in some different answers and it'll give you a ballpark. Again, it's kind of a great source that just tells you what your approximate need may be. But if you have questions, again, my information is on this. Feel free to send me a question as well. I know this can be something that is maybe a little bit tricky to navigate. The personal liability umbrella policy, this is generally an additional coverage that comes on your homeowner's policy. So this is one that, again, we have seen more and more lawsuits that have started to come out, and it can be any sort of thing. It can be, an accident. It could be someone's injured at your home. If you have pets, if your pet injures someone. So this is something that, again, it kind of adds an additional veil of protection over your assets. So if somebody does slip and fall on your sidewalk and get hurt and now they can't work and they try to sue you, there's an additional amount of benefit here. We generally recommend to clients that we work with to match your umbrella policy kind of just slightly above what your net worth is on kind of a non-401k protection. So most 401k retirement plans have some sort of government protection from ERISA, but this would be something that you want to protect kind of your personal assets as well. And then the last one that we're seeing more and more of is long-term care insurance. Understanding the differences between some of your traditional policies or some of the newer asset-based policies. Again, I would tell you that there's not a one-size-fits-all right answer here. You can get long-term care insurance all the way up into your mid-60s, late 60s. So I'd say there's never a point that you can't explore that route. But this tends to be a very personal topic that everyone's gone through slightly different experiences with family, parents or grandparents, and maybe they've had a fall, maybe they've had any sort of accident that has caused them to need to go get long-term care. So understanding what your options are is a piece of the financial plan that I think we want to cover. Sometimes when we look at that in someone's balance sheet, they might have built up a large enough balance sheet that they just say they want to self-protect. They want to fund those costs themselves. They don't want to pay the expense of the life or the long-term care insurance, and that can be the right answer. Again, there's a lot of ways to protect some of these different categories. It's just understanding what fits best for you. And then here's just a visual with that umbrella policy. So again, I think this is something that maybe we don't think about enough. We've had clients that have gone through some of these circumstances. If you've got a pet and your dog, I'll use a dog for this example, you've got a neighbor that's a doctor or a surgeon, they're walking by and your dog bites their hand and they can't work for some period of time. They could potentially try to sue you for lost income. Having an umbrella policy helps protect your personal assets. And, their attorney would much rather settle with an insurance company than try to go after you personally. But that's kind of where this can be a beneficial coverage. Umbrella coverage is generally pretty inexpensive relative to a lot of the insurance that's available, but it can help protect you and your family against, something that, again, you never want to have happen, but obviously accidents happen all the time. The last of the insurance topics that I wanted to cover was business owner insurance benefits. If anyone is a business owner, they may already know a lot of these. Sometimes we have clients that want to start their own business, but they don't know where to start. This is something that maybe is a useful tool for somebody who's in that camp that is looking at that as an option, but doesn't know, even from the insurance side. So again, life insurance is one that we generally see for business owners. You may want to have a buy-sell agreement in place, which is an estate document that attorneys would help you get set up. But if, let's say that there's you and a business partner, if something happens to either one of you, does the business still continue on? Does there need to be cash in the business to help hire someone else to help keep the business going? So again, these are some key options to think about. Business succession planning can be a big piece of this as well. Maybe it's a family business and you've got, sibling or children that are coming in, and maybe you've got one child that's in the business and other ones that aren't. Life insurance can be potentially a way to help, again, keep that child that is in the business operating and not having to split the value of the business to the non-participating children. So a lot of things to consider, but just something that I think is an important topic. Just like on the personal side, business owners should have a liability insurance here as well. Obviously, if you're a business owner, you have employees working for you. There's a potential for them getting hurt, the potential for them hurting someone else. And again, that might be they're driving a company vehicle and they get into an accident. That could be something that could fall back on the business. So having some liability insurance here is an important coverage. Then there are going to be some federally required insurance as well. So again, workers' compensation is one that most people are familiar with, unemployment insurance, disability insurance. So again, I think the big thing here is if this is an avenue that you're going or you're under, I think it's worth, knowing what your requirements are, what your options are. Each state is different as well, so I can't necessarily speak to every single state that's out there, but I think it's worth knowing what some of the high-level pieces are. On the investment side, so this is kind of where we'll jump into our investment philosophy, kind of thinking big picture, how everything works together. I'm going to start with our investment philosophy. So this is Lutz Financial, where I work. This is our investment philosophy. This is how we invest our clients' accounts, how our 401ks are invested. But we believe that there are factors that can help improve your long-term success. We do think markets are efficient. On any given day, there's millions of people that are selling stock, buying stock. And if they're selling or buying, it's because they think the price is fair. You wouldn't go out and buy a company's stock if you didn't think that it was a reasonable price. So we think that all the information that's publicly available is out there and being used, and that's priced in. Obviously, when companies report their earnings, that's something that's unknown to anyone that's internal or outside, anyone that's not internal, and that impacts the price. So you see a lot of times on days that companies report their earnings or give guidance, the market may move very significantly on those days because that's new information that's being processed and being priced in. We think low-cost investment options, or in this case, index options, also add a lot of value over time. It's extremely hard to kind of know what the market's going to do at any given point. But we do think that being low cost is one factor that is beneficial all the time. Being broadly diversified, again, I think that we see this a lot of times in any given year. There's a few of the, top companies, top performers that everyone's talking about, everyone hearing about. But those companies didn't get to that point without kind of coming from a smaller stage and growing into it. The best way to capture that growth over the long period of time is being very broadly diversified. And again, I think this next one here, using the appropriate investments for account type, we think that it makes sense to have different investment profiles in different account types. IRAs, Roth IRAs, you're not going to pay taxes on dividends and income. So those don't have to be near as tax efficient. But like if you have a joint account, an individual account, a trust account, we want to be very tax efficient in those accounts, just because, again, we don't want a lot of portfolio turnover. We don't want to pay a lot of taxes in a given year because the funds that we were in did a lot of trading. So I think that's something that we want to make sure is appropriately allocated inside of a portfolio. Unemotional or systematic rebalancing. Again, if your target of a stock to bond portfolio is 60-40 and the stock market does really well, inherently we should be trimming some of that down. Conversely, if we go through a COVID or 2008 where the stock market goes down 20 to 30 to 40%, that's when we want to go out and we want to rebalance from the safe conservative bond bucket to go buy stocks when they're at more of a fair price, you could argue. So I think that unemotional rebalancing helps. A lot of times your 401k or retirement plans have a feature that allows you to rebalance it. Again, we think that's a great tool. And then naturally, as you're investing into a lot of those buckets, if you're in that accumulation phase, you're going to be always buying those different buckets. So even when the market goes down, you're buying and accumulating more shares. And that is also beneficial to the long term. And the last one, again, invest to your appropriate timeline. So this is really where we're looking at that, saying somebody that's, earlier in their career in the accumulation phase, they can probably afford to be a little bit more aggressive with their portfolio because they don't need those funds today or next year. Somebody that's on the horizon of retirement or in that spending phase of life, that's where, we probably want to be more conservative. And I think when we kind of look at some of those things, we'll kind of break into it here. Thinking about the index funds versus active managers. So what does this mean? Index funds just try to buy an entire index. The S&P 500 is an example. That's the one here on the left. There's a lot of fund managers that are out there, whether it's in, Omaha, Nebraska, California, New York, wherever. There's these large mutual funds or exchange traded funds that are going out and they're trying to pick a basket of stocks that are similar to that large cap US space, but they're trying to beat the stock market. It's extremely hard to do over long periods of time, especially when you factor in the cost of some of these options. So you can see here about 15% of the funds that are trying to beat the S&P 500 beat the S&P 500. So that means 85% of those failed over a 10-year period. And that holds true kind of across most of these different areas. The Europe index, the S&P Europe 350, here you can see it was even a greater percentage of funds that didn't beat their index. So again, that's why we think using that low cost option allows you to participate in the market growth over time without missing out on, the company that may run up that my fund advisor sold to early or whatever else. So we think this is a great way to add value over the long term. Ultimately, we do think that the investment risk is what drives the outcome. So how aggressive or conservative you are really leads to having, a little bit higher annual return. But really, this is important because it's only if you can withstand the volatility of these time periods. So, and again, you'll have access to the slide deck so you can look at some of these numbers as well. I won't go through all of them. But if we work from left to right, you're going to see the more conservative you are, generally the lower average return that you would expect to see, again, because you're taking less risk. So we understand that. And you can see that during any, in the worst 12-month period, and again, this is about a 100-year time horizon since 1926, the worst 12-month return for that conservative blend portfolio, it was down 17%. So again, if you're in that distribution phase, you don't want to see your principal take a big haircut while you're trying to pull money out. The aggressive growth bucket, that far right one, you can see that in the worst 12-month stretch, your portfolio was down 60%. And again, obviously we know because we're now at the end of this 100-year window, as long as you had a long enough time horizon to ride through that, you did okay. But the worst thing that we could do is sell or need to sell because we're trying to live off of it at that time period. So having an appropriate risk allocation, I think, is very critical to anyone's long-term success, because the biggest thing is we don't want to sell unless we want to pull funds out. We don't want to be forced to sell just because we're trying to live throughout retirement. And that's where I think diversification really comes into play. This is about
not a big difference then between them and Spencer, huh?
This is where if you look at the last 20 years and the market volatility between any categories, you're going to see the gray that's in the middle. It's kind of that balanced area. This is where you're going to see a balanced fund tends to smooth out the ride. So somebody that's in retirement, they probably don't want to see all the highs and lows that you kind of see across this board. But that's kind of where, again, making sure that you have an appropriate allocation can help smooth that ride out for long-term investors. This is that 2008 recession that, again, some people probably remember, others may not have gone through that. But if you look at October of 2007 through March of 2009, the S&P 500, the US stock index, lost about half of its value over that 18-month period. It took an additional 3 years, all the way to March of 2012, for the S&P 500 to get back to where it was in October of 2007. So this is one of the challenges that people face when they're looking at retirement is, what is the appropriate allocation? I'm guessing somebody in retirement doesn't want to wait 4.5 years to try to live off of those funds in their portfolio. So having the appropriate risk tolerance really leads to being able to weather the storm. And we call it sleep well at night portfolios. A client that's in their 60s or 70s that's trying to live off their portfolio, they may not care if they get every inch on the way up, as long as they know that they have a systematic amount that they can pull out and not worry about what's happening in the stock market over any given time period. But again, I think one of the key things here is focusing on the long term. And one of my favorite sayings is doing nothing has consequences as well. If somebody just had cash and they only use cash as their investment because it was safe all the way through since 1926, $1 over that about 100-year period was worth about $23.20 at the end of 2023. With inflation alone, that was at $17. So that means that $1 can buy barely a little bit more than what the cost of inflation was. Bonds are obviously more conservative. They went up a little bit more than cash, but you can see the power of investing over long time periods. This is the growth of $1 over a 100-year period. And obviously, a 100-year period is an extreme. I would argue that most of us on this call don't probably have another 100 years to go through an investment cycle like this, but you can kind of see that those pullbacks or recessions, when they happen, obviously they happen fast and they can be very strong on the downside, but having the right time horizon is really kind of the most important part here, to know, again, how that you want to be invested over that horizon. The last thing that I was going to talk about here on the investment allocation piece is thinking about this 3-bucket approach. It's something that we use with all of our clients, but it's making sure they have enough set aside in buckets number 1 and bucket number 2 that they can let that bucket number 3, the stock piece of their bucket, fluctuate over the long term. Because ultimately, we don't know when the next recession is going to happen. I would argue if anyone tells you they know, they're lying to you, because it has not been something that's been predicted well consistently. But if you think about this, and again, I just showed you the 2008 time period, if you have enough in buckets 1 and 2 that you don't have to sell stocks when it gets tough or choppy, then it allows you to take from that safer conservative bucket in those challenging periods, and let that bucket grow and recover if there are any market fluctuations. Similarly, if someone's younger in retirement, they may not have any portfolio needs for the next 10 years. They might be able to have their entire investment assets for retirement in that growth bucket, knowing that it's going to fluctuate. Again, knowing that they're consistently adding to it on a month-to-month, year-to-year basis. That does still lead to the longest or the best long-term outcome, but only if you can ride through the volatility and not be forced to sell when you don't want to sell. The last topic that we wanted to cover today was some estate planning and legacy planning ideas. So really, when we think about estate planning, there's a few objectives that people generally want to accomplish. They want to protect their family or beneficiaries. They want to pass assets or property, to family members, to friends, to organizations. But determining how you want those assets to flow is a big piece of it. If you are a business owner, protecting your business is generally a big goal for estate plan purposes. And then potentially minimizing estate taxes, depending on where you fall. The estate taxes have increased pretty substantially here over the last 20 years, but it wasn't too long ago that the estate tax threshold was just north of $1 million, $2 million per person. That would have been a lot more restrictive than it is today when it's at about 14 million per person. And again, this kind of goes back to the tax legislation. That can always change. So far, we haven't necessarily seen a change that has lowered it. The current laws are scheduled to sunset, but this is also a topic that we think will come under a little bit more probably press as the year goes on, and seeing how the new administration handles the current tax laws. So I think the big thing with the estate plan is making sure that you have a coordinated estate plan. There's a few documents that are especially important, and it kind of depends on any person's situation. So a last will, this would be a document that, again, you designate a lot of your beneficiaries. You designate the people that would step into power for you if something were to happen, if you were incapacitated. So a lot of times there's a healthcare power of attorney. There's a financial power of attorney. If you have children that are minors, who would be the guardians for those children? So it's really kind of a tool that's a backup plan for any assets that aren't titled as a beneficiary. So most 401ks or retirement accounts, they are going to have a beneficiary listed. And so I think, again, this kind of is the goal of this part of it, but make sure that that's coordinated with your estate planning documents. And that's kind of where the beneficiary piece comes in. So a lot of times real estate, you can list beneficiaries, even bank accounts. You can a lot of times have a POD, a payable on death, but those are only as good or powerful as they are if they're paired together with the rest of your estate plan. Depending on how complex a person's estate is, they could put a trust in place. And I'll talk about the revocable trust. This would be something that you have in place while you're living. You can make adjustments to it. You can change things, but you can be very descriptive of how you want assets to flow, who you want to have control of certain things. So again, this is a very powerful tool. And I have got a disclosure on here too, but I think this is specifically an area that you want to consult with an estate planning attorney. If you have questions on, laws will vary from state to state, and every situation is a little bit different. So this is not one, again, that we can give a blanket answer to, but this is a very personal, individualized piece of it. When we're thinking of estate planning, there's really going to be kind of a range of what applies to people. So again, your foundational pieces, we kind of just ran through your wills, trust, powers of attorney. So here, again, that can be accomplished from your wills, your trust documents. But really, I think a big component of that is the financial planning piece and how it ties in, knowing what your situation looks like, knowing if you have life insurance to help. Again, maybe you're helping minor children pay for school. Maybe you want to help a surviving spouse pay for the mortgage, things like that. So having that financial plan in place and coordinating it with the foundational pieces is very important. As you think about some additional basic estate planning topics, you can do annual gifting. You can give up to $19,000 per person. You can fund college education accounts. You can pay directly to a tuition or a college or a health facility for some of those costs. So really, if someone has an estate tax problem, before we get to any of the advanced topics, these are some of the options that we would explore first before, again, making an irrevocable trust or some of those other ones that do get to be a little bit more complex. But that's where, and I'm going to open up these next three all at the same time. I would tell you that if your estate is larger than $15 million, some of these higher advanced ones are probably going to be more important. I've got the acronyms on here and I can read them off, but grant to retain annuity trust for GRAT, spousal lifetime access trust for SLAT, intentionally defective grantor trust for the IDGIT, and then irrevocable life insurance trust for ILIT. Those are four more advanced strategies that high net worth individuals would use to help prevent having to pay estate taxes. So again, I think the big thing that we work with clients on is what does your situation look like? What does retirement look like? After we have a plan in place, we can look and see, is there an estate tax problem? Should we be doing more of these advanced strategies? So that way we can pay as little in taxes as possible. If you're a business owner, it's not hard to see that, again, if your business has been successful and grown, you may fall into some of these categories where you would want to start to do some of these advanced planning strategies. The charitable piece, there's some more complex estate planning tools for large balance sheets. We'll get into some of the more kind of blocking and tackling ones here in a second, but there's some other tools to use as well. So I think it's just worth knowing what your options are and how to best implement some of these. So the last area that we want to talk on is some of the charitable gifting strategies. So the first piece is gifting during your lifetime. Ultimately, there's a lot of ways that you can give. You can give just from checking and savings. You can give other methods. Our goal is not ever to tell clients what they should or shouldn't do with their funds, but help them maximize whatever their goals or intentions are. So a big one is, we have a lot of clients that are very philanthropic and they want to give back. What's the best way to do that? So during your lifetime, a donor advised fund is a great tool to use. So instead of giving cash to an organization, you can give appreciated stock into a donor advised fund. And the benefit here is that you can avoid capital gains. So I'm in Omaha, Nebraska. I'm going to use Berkshire as my example. Let's say that I bought Berkshire for $10,000 and it's now worth $50,000. And based off my financial plan, I've decided that I want to give $50,000 to an organization. Instead of using cash, I can give that $50,000 of Berkshire stock into a donor advised fund, and then I don't have to pay the capital gains. Maybe I'm a really big fan of Berkshire and I want to go back and rebuy that stock. With the $50,000 that I was otherwise going to gift, I can now go rebuy the stock, and now my cost basis is $50,000, not $10,000. So again, you can kind of see the benefit of how that can help work with your financial plan over the long term. Another one that we're seeing right now, and again, this is under the current tax administration, but you can bunch multiple years worth of gifting into a single year. Again, right now, the state and local tax cap for your personal tax return is $10,000. So there's a lot less people that itemize than there were back in 2017 and prior. So maybe you want to make a larger gift this year to get a higher tax deduction, but you don't want to give those funds out for, again, all in one year. Maybe you want to give them out annually to a church or a school or to ASABE. So again, maybe you want to give funds to these organizations, but you want to do it on more of a kind of a spread out time horizon. This can be a powerful tool for doing some of those organizations. Another one that you can do during your lifetime, this one's a little bit more restrictive, but once you're age 70 and a half, you can give directly from your IRA. So again, let's say that you've worked, you retired, you had a 401k, you roll it into an IRA, you can now give up to $108,000 per year into or to a qualified charity. So again, it has to be a 501c3 qualified charity. As long as it is, you can give directly from your IRA to that organization and you don't pay any taxes, the organization doesn't pay any taxes. So that can be a very powerful tool. I know the RMD age, those required minimum distributions, that has changed a little bit to either 73 or 75. But if you are at that age and you're required to take distributions, you can actually use these qualified charitable distributions to offset that. So that, again, can be a powerful tool where, again, maybe you have other sources of assets that you're using to live off of. You don't want to take from the IRA, but the IRS is forcing you. You can give that to a charity and not pay taxes. The second piece of this is leaving assets upon your death. So again, there's a few ways to kind of structure this as well. With the IRA thought process here, you can leave that to a charity as a beneficiary. It can be a full beneficiary, it can be a partial percentage. Maybe you want to leave 10% of your IRA balance to an organization. You can list that on your IRA. That's one of the more tax efficient methods of leaving assets to an organization versus, sometimes we'll see people that have it in their will or trust that I want to leave X dollars to this organization. If you're giving dollars to an organization from like your checking and savings account, it's less tax efficient than from your IRA because your IRA is going to be taxable to your beneficiaries unless it's a charity. So again, whether it's family members, whether it's friends or whoever might be that beneficiary, if they inherit your IRA, they have to pay taxes on the distributions, no different than you would have as the owner. So this is a powerful tool that we see a lot of clients utilize. And then again, donor advised funds, the benefit here. So again, I'll go back to that previous example. Let's say that you wanted to fund 5 years worth of your donor advised fund in a single year. There might be a larger balance in here. You can designate a successor owner. Again, maybe it's kids, maybe it is just a charitable organization. But that's a good way that we see a lot of clients pass on that charitable mentality to their kids or grandkids or the next generation. So that can be a great tool to use to help, one, accomplish your charitable goals, but do it in a very tax efficient manner. So on here, again, I've got a few different resources. Our chief investment officer writes a weekly blog post about the markets. It's very timely. This week he talked about tariffs, just kind of show for an example. So I think the goal is here to give people an unbiased opinion on the markets when you're hit with so much noise from a lot of these media outlets on either side of the fence. It's just a good kind of resource here. And also the two other resources of calculating your tax bracket. I mentioned that was an important piece of knowing where you're at today, trying to get an idea of where you will be in the future. And that's a good tool. And then evaluating your life insurance needs, that one's on here as well. Before I jump to questions, I'm just going to pull this up. So again, Lutz, we are a business solution firm here in Omaha, Nebraska. We do work outside of the Nebraska area, but we're the largest CPA firm in Nebraska. But we do help clients with financial planning, with tech needs, mergers and acquisitions. If you're going to sell your business, get a valuation, doing some consulting or talent. So that's our quick Lutz pitch. But if you have any questions, reach out to myself. Reagan's here as well, and she can help direct it to the right area. But we're happy to help answer questions that you may have.
Thank you, Tom. That was fantastic. So much information. We had just a comment, a reminder to, if you already have a will in place, to make sure to continue to review that in light of state and federal regulations and changes.
Yeah, absolutely. That's a great point. And we tell everyone, try to, again, refresh those documents every 3 to 5 years as well. Life changes. An example that we use for clients as well is maybe you had a child listed as the power of attorney, but maybe they moved to a different place of the world and they're no longer the closest person. You might want to update it for that reason. Maybe you had these estate documents in place and you've now had grandchildren. And what happens if your child predeceases you? So just some things to think about. This is, again, a very personal topic. It's hard to give a blanket answer for everything, but we do think that with the right plan, you can help accomplish a lot of the goals that we have. And if you have questions, so this PowerPoint slide will be available. My email is on there as well. Feel free to send an email. If you have a question, happy to answer that. I would just say reference that you were on this webinar. So that way I know how to potentially answer that question, but happy to answer any questions that come in later.
Got a lot of folks out there digesting all of this information they've just given us. Thanks for that.
Absolutely. No, and it's a lot. It's a lot to cover in a 45 minutes, an hour presentation. Truthfully, each of these categories could probably have a subsection on it, but happy to answer questions as they come up.
And we did just have a question come through the chat.
Yeah.
Do you have advice on forecasting your retirement tax bracket?
So I would say start to think about what sources of income you're going to have in retirement. Generally, if you think about the income tax brackets, legislation aside, we've generally seen those brackets have increased about the same amount as inflation has. So again, if you were projected to have $40,000 of pension income, I would say you can kind of boil that down to on today's tax brackets because they're probably both going to move a little bit in tandem. But start to think about what sources of income you would have. So Social Security, if you haven't done it, I'd log on to ssa.gov and figure out what your Social Security benefits are projected to be. Again, this is another area that we hear a lot about with legislation, what changes may happen, but this is certainly something that we want to monitor or know about. So that's a bucket. You know, if you have any pensions or if you own a business or a farm or things like that. Again, another question that's tough to answer, but you may inherit assets that would change your picture as well. So sometimes just having an idea of what your situation looks like would be. But then with your 401k or your retirement plan, a lot of times you can, again, project what you would need from that on an annual basis. I think a rule of thumb that we generally say in the investment world that you could safely pull from your portfolio annually is about 4% per year, and you would never really dip into your principal or spend it down. That may not be right for everybody, but that's a good way to project out. So again, if you had a $1 million 401k when you were 65 and you took 40,000 a year, you could live for 30 years and not spend that all the way down. And again, that's not the right answer for everybody, but that's kind of a starting point for projecting out what you think taxes might be.
Excellent. We had another question come through. If you're interested in giving a portion of an IRA RMD to ASABE, lots of acronyms there, from a mutual fund, what do you actually do to make it happen? How can you help Liz, myself, help the donor make it painless?
So you would want to work with whoever the custodian is that holds the account. So like here at Lutz, we use Charles Schwab as our custodian. And for our clients, we have a lot of clients that do make those distributions annually to organizations. They would make the check payable to the organization. So ASABE in this example, the check is made payable to that organization, and then they can mail that to your address on file. The big distinction there is make it payable to the organization, and then you can deliver it to the organization. Another important note here, and I don't know if you do your own taxes or have an accountant do your taxes, the accountants will need to know that that went as a qualified charitable distribution because they have to code it on the taxes as such, and then that makes it a non-taxable distribution for you. If you have specific questions, we can help a little bit more on that as well off the webinar.
And if you have specific requirements for your designation, if you have a particular fund you want those dollars to go to, make sure to let me know that, and we will ensure that that is tracked appropriately.
Yeah, great question.
Well, as we wind down the hour, I just want to thank Tom again and to all of you for participating today. I will add that we do have a few folks who have declared that ASABE Foundation is part of their estate plan. So thank you for those of you who fall into that camp. If you are interested in learning more about that and having conversations, please reach out to me. I'm happy to chat with you about what that could look like in terms of donor recognition, help with conversations with your family members, because we don't want them surprised upon the reading of your will that you've designated some assets to ASABE. And then, of course, that designation to make sure that those gifts are continuing the legacy of the work that you have all done for many, many years. So please reach out with questions. All right, very good. Well, without any further questions, I think we're going to call it a session today. Thanks again, Tom and Lutz, for the information today. We really appreciate it. And we'll get these slides and the recording out to you as soon as we are able to.
Great. Thanks for setting this up, Liz.
You are very welcome. Thank you.